Hello, friend. Let's wait for another minute before we start. We will wait for a minute for people to join and we'll start. Hello, everybody. First of all, I'm extremely sorry for delaying this interaction. Something came up and I had to attend it, and hence I was not at a stable location to take this. So sorry for the delay. Uh, let's start with the market first. Lackluster week, but sometime lackluster is good, and that's what I will call this week, which went by. That the fall kind of came down, the market found themselves in a range, while some of the negative news had a large impact in the scene being a great example, and positive news not getting rewarded. So overall, which means the texture of the market continues to be, I will say, mundane in the nature. We are not falling, but there's nothing exciting in the market. The sense still remains that there's limited upside, while I think there's a consensus building now that large caps have limited downside also. And I think a lot will depend on what happens in the upcoming result season in April. Because if you look at it, the government did their need part of it, where the budget, improving on the capex, getting more of focus on the execution. RBI is taking care of its problem in the liquidity cycle. The the global markets have remained a bit volatile, but has been fairly fine. Crude and bond yields are not going up while gold continues to rise. Overall impact seems to be that of a consolidation in the market. My technical team tells me that if we don't fall below 21,800, till we don't fall below 21,800, we don't see panic coming into the market. And for us to have any sustainable rally, we need to close above 23,200 and 23,500. So basically, the current view seems to be that till the result season start, and that also coincides with the April 2nd deadline for Trump announcement. We are getting into a trading zone and maybe a stock specific movement rather than anything. FIIs, which are the hot topic and which is the topic we will discuss today, continues to be net seller, though on a lower quantum. Before we understand that why FIIs are sellers, let's understand different kind of FIIs, because we use a terminology which is foreign institution investors, but there are various kinds. So there is a set which we call a pure long only long term investors, like the typical investor. They are entities are called FIIs. There's a huge trader community, which we call the hedge funds under the FII, who purely believes in the concept of making money on the positions. There are momentum traders. There are there are investors who decides across equity markets, across markets, and are called like pan Asia investors, EM investors, various kind of equity investors who don't only invest in India, but they do on various countries and various strategies, and they take their positions on India. Uh, there are similarly funds which do across the strategies, which means that they invest in bonds, they invest in commodities, they invest in equity wherever they see an option to make money. And there are people, and rather there are traders who do long short of both and across all the strategies. So FI is a ocean which is a mix of various kinds of strategies, various investors, and they are all clubbed together. But within that, each of them has their own thoughts, each of them has their own strategies, each of them has their own mindsets. But broadly, the summation of the FIIs in the last 6 months have been that they have been net sellers, because most of these segments have been net seller while the buyers are not excited. So why is that happening? I think the first and the biggest more reason is the constant correct, I will say, depreciation of the currency, because the FIs either they borrow in dollars or they judge their returns in the dollars, because that's the standard currency. Most of the money comes from the LP who look at their assets in dollar terms. And with an average depreciation of currency of 3 to 4%, either either it goes away in form of a hedge, or it goes away in form of a natural depreciation, as a result of which what we see in the INR terms returns get lowered over a period of time. So a stable currency or a appreciating currency brings a lot more flows for us, which is where inflation becomes a very important factor, because a high inflation environment creates higher bond yields and higher depreciation in the currency, hitting both the earnings and the risk part of it. So India relatively had been better off than global on inflation, but in absolute terms, the inflation has been a concern. Depreciation in currency has been a concern. As a result, the limited upside in the near term is something which is there in the mind. And if the earning confidence is not there, then even though India after this correction is a value buy relatively in large caps, but because there is limited upside in the near term, they will wait for stability to come before they decide to buy. In the meantime, the market texture continues to be poor. As a result, the short sellers or the hedgers are more inclined to finding short ideas, because they make money there. At the same time, what is happening is US bond yields are not stopping going up. What happens when you invest in US bonds? Not only if you hold till maturity, you're assured of a dollar return of 4.5% if you are investing for 2 years, which is not a bad return. But if the bond yield corrects over a period of time, then you will get a appreciation in terms of bond prices also. So as a combination of the two, I have a fixed return on the downside. And if there's a bond yields come down, then I get a correction. Then I get appreciation in terms of bond prices, and hence my return both on the bond, because of the combination, will be higher without taking any risk of the equity. Which is why when bond yields come down, the existing investors decide to sell it at the same time, because they are booking profit, and because the new money doesn't come, because the inclination goes down, that money moves to equities, which means bond yields and equities have a very strong inverse correlation, and that being elevated in US terms is hindering the equity markets across EM, and more for India, because over the last 5 years, the FIs have been overweight India, because India has, and truly so, has been the most strongest economy with little geopolitical risk. But having said that, if the earnings growth are not going to come, the market will not sustain at these levels. That's something which investors understand. And hence, they have been offloading the overweight part of it or not buying it. But with this correction, we are near the bottom in terms of valuations when it comes to large caps, and which is why the pace of FI selling has come down and is expected to come down further. The FIs will turn buyers in India, and definitely will turn buyers in India, if the following parameters work out for us. First thing, confidence of earning growth. I think that's the foremost and the most important parameter here. The second thing is correction in the global bond yields. Then the money will stop going into the bonds and will come back to equities, and India will get their share. The third thing is slow down or correct or stopping the continuous depreciation of the rupee. I think that has also stagnated. In fact, we have a view that the rupee will appreciate over the next couple of years because the US economy is in a more troublesome than what it is seeming at this point of time. And the moment that happens, you have the DM to EM trade coming in, which will bring a lot of money into India, especially because India is now fairly valued or cheap when it comes to large caps. With the confidence of earnings, which is the most important thing, you will see money coming into the market. But for FIs to remain buyer in India, we need earning growth. There is a strong correlation between the FI money and the earning growth visibility. And whatever we are seeing over the last couple of months is because there have been a slowdown in the earnings growth. So earnings growth is the fundamental reason we invest in any stock. It's the fundamental reason one should always invest in the stock, and that's where the large FI investors do it. So for all the noise around FI, my understanding or an understanding of Team Stag is very clear that if earnings growth is there, FIs will come back. And if bond yields are going to be elevated, then the selling will continue. These are the only two parameters we are looking, and obviously we track the DXY because the currency gets impacted with it. I, while there is no publicly available data, I believe the hedge funds are heavily net short India because of the texture in the market. And one positive news on earnings in April will lead to buying from the long only rise and will could lead to short covering from the hedge funds. So the bug stops at earnings growth in April. That's something which we are looking forward to. We saw some signs of bottoming out of the stagnation of earnings in October to December quarter. We believe Jan to March quarter will spring a surprise on the positive side, but the market will be very, very stock specific. Another point, FIs have sold nearly $20 billion over the last 4 quarters. 200, $200 billion. Yes, $200 billion over the last 4 quarters. What have they done to the portfolio of? What have they done in the stocks which are part of the stack portfolio? We ran the numbers. Interestingly, Bharti and ICICI Bank has seen some increase in FIA holding. Everything else has seen some holding decrease, which is natural. But none of our portfolio stocks has seen a sharp selling by the FIIs. And in fact, wherever we have seen selling, there have been a counter buying by the DIs. As a result, we have seen is there is no major change in the institution holding for the stack portfolio, and that is where the confidence is, because it means that the inherent quality of the our portfolio stock and the inherent confidence on the earnings of our portfolio stock is very much intact when it comes to institution investors. That's from my side today, guys. As usual, we'll wait for a few seconds for any questions. Else, enjoy the weekend and let's hope we will have a good week ahead tomorrow. Waiting for any questions, if any. With no questions, thank you for your time. See you around next week at 11:30. Thank you.